Welcome to the Cirrus Market Outlook. This is Satya Pradhuman, Director of Research. The recent dispatch, and the dispatch is our quarterly outlook report. It's meant to be pretty to the point, covers a lot of our thoughts, tries to stitch the themes together, and it's presented with a ton of really really charts that the team pulls together. We hope you guys are enjoying it. And as always, clearly we're looking for feedback because there's always room to improve. The title of this report is When Investors Chase the Pick and Shovels of the AI Trade. And to some degree, I think I should probably define pick and shovels. What does that mean? For most of us, I think we think of the pick and shovels idea about, and that harks back to the gold rush days when you had speculators looking for gold, and the folks that were sort of skeptical of that figured, hey, you know what? Let me just sell the picks and axes and shovels, and I'll make some money there. So to some degree, with this sort of recent period of the ChatGPT offering, the APIs that have come about, the market is completely excited about this. Everyone's looking high and low on how to get involved. Along comes this wonderful chip company, NVIDIA, that is just in the middle of this moment. And what it's managed to do in a short few months is to drive the sort of extended FANG names about 90% year to date. And so what we're looking at is one of this meteoric rise in a market that was at the start of the year. Most folks watching this closely were fairly skeptical about where markets could go given all the wall of worry. And so, there are many new names for this, the extended FANG, the Magnificent Seven, the Nifty Seven. This sort of ties back to the old fashioned Nifty 50 when it took 50 companies to dominate the market. So in this kind of world, the kind of performance pain most of us, our clients are experiencing, our blends are experiencing that we run, it's pretty awful. Because if following the tenets of good portfolio management, diversified, fundamentals are in place. Well, guess what? Diversified? No. Fundamentals? No. And to some degree, the sort of excess that we're seeing in the markets, the portfolios themselves have just really, really been challenged. I will put out our numbers out there just to give you a feel of our pain. The GARP model that we run is underperforming the growth benchmark by about 20 some odd percent, and same with our quality growth model at 25% down to the growth benchmark. Moral of the story is that any of your disciplines that are looking to track and find names based on the organic growth of the firm, the valuations of the company, the exposures, et cetera, the visibility of the earnings. I think we could probably shelf that. So this period has been really, really challenging. Having been in this business for a few decades, we've seen this before. So to some degree, we get the sort of cynicism, skepticism that's really circling most investment managers. And to some degree, the question is, if you're really lagging, how much do you chase this thing? And because to be quite honest, we can see how excesses in the system can run a lot longer than they're supposed to, quote unquote. And so this idea of everyone being bearish, I had a client call or a conversation earlier in the week, and the investment manager said, well, some of my guys that are looking at their portfolios, if you want to talk to them, they're really trying to avoid strategists because all of them are bearish. They kind of get the story. What's the point? And I think that was a great comment because we all get the joke. You're in one of those special moments. I sort of think back about this sort of current moment. I link it back to the great Ron Chernow's book of House of Morgan. And in reading that, and I can't really attribute it in the right chapter because that was a long time ago, but there was a line that stuck in my mind when I first came across it, which is that it was telling of a period in the late 1800s where the investment sentiment was really negative and really negative, and the markets just went through it. And at some point, the line was, at some point, the consensus will be right. And so, to some degree, yeah, sure, but that doesn't help you really capture gains for your client, generate alpha, and all the things that we're really meant to be doing. So what I wanted to do was really track back this period and really look to what is underneath this moment that we can make a decent case that we've sort of moved off from a fundamental platform and we're now sort of a tactical trending market. And this too can exist. And, so I don't think it's good enough for me to sort of dig my heels in the sand that look at all these excess valuations that I'm about to share with you. And therefore, the market's wrong. But I think we have to sort of breathe in and sort of look to this way the market's trending and think about it in this term that there's a whole other set of tools that we've got to also consider. So what the Cirrus team in the last few months, we've had to honestly accept that we don't necessarily want to chase this AI trade moment. I think, don't get me wrong, a huge fan of technology investments. I'm probably not the expert in the space, but I do think I link this AI moment to blockchain, also another wonderful technology that's going to sort of like work its way out in time. Investors can get really excited, pile into the blockchain thesis, and then stocks go up a lot. But then again, stocks can also come down quite a bit. And I think of this in terms of the AI moment because to some degree, there's a lot of uncertainty about how this rolls out, incredibly powerful in terms of efficiencies and benefits. But in terms of the rollout and the practical working of this new toolkit, there's plenty to be done. And there will be beneficiaries, but there will also be some going down the wrong road. And so to some degree, why the market has sort of picked this moment, I would sort of link it back to somewhat of a behavioral element, which is we've just come out of this massive rally in tech stocks. The stocks have reversed sharply, but deep down inside, we want to get back to where we were comfortable. And I think there's a little bit of this. We've seen this before. If you go back to the break in the Y2K trade, back in 2001, markets got clobbered. And then for a year or so later into 2003, the tech sector rallied and then broke down for the next several years. So to some degree, I sort of feel this is, and I'm going to refer to this as the great echo trade. We'll go through some color there as well. But this current moment, though, what I'd like to do is really sort of separate out this sort of tactical moment and think a little bit, spend some time really on the fundamentals and the strategic rotation that might be underway, and then talk a little bit about how we frame for the upcoming period, because we think that there will be a break in leadership and there will be a rotation. So the first part I want to do, which could be pretty challenging, but I'll do my best to sort of defend this moment, which is if you're in a tactically driven market and a trending market, what are the properties of a trending market and what are the tools we're looking at that can help us understand where we sit? And I've got to say what triggered this moment is really interest rates. I know this wonderful technology is here, but honestly, the AI moment has been coming along for quite a bit. We've been, in logic-based systems have been in place for a long time. It's now climbing this new scale. The app that's just been generated, the ChatGPT moment, is really putting it in all of our desktops and our phones. So what we've looked at, there's 3 or 4 things that I've got to sort of underscore. But the interest rate component of this is massive. That it's, coinciding this technology was a few months ago, this idea that, hey, the Fed policy may be coming to an end. You had this sort of mini sort of regional banking crisis that sort of came up, reared its head and went down, hopefully. And I think what that did was instruct investors that, hey, If you're worried about interest rate risk, it's probably behind us. So now we're probably back to where we were before. Let's get back into it. So these things sort of coalesced and have created this very, very special moment, or aggressive tape moment. In terms of what we're looking at, several things. Crowding. Is the market very crowded? Our recent signal clearly went that way. Asset allocation models, we'll talk a little bit about, do those models also, are they asking us to take risk or shy away from risk? Where credit spreads, and also things like risk appetites. So what I want to do is walk through these elements briefly to say, look, if this is a tactical trending market, what are we looking to model this thing? Because I cannot stick my head in the sand and say, I'm going to grab my marbles and go because you guys aren't playing fair. You're not paying attention to the fundamentals. And so one of the elements that we're looking at that's been super helpful in the last few decades has been this, what we call the CRX, the Cirrus risk score. This is basically a proxy for measuring risk appetites in the system. And I won't go into all the math of it, but the gist of it is that it's looking at intra-market rotations between speculative things and defensive things. So if a lot of high beta stocks are outperforming low beta, that's 1 point for risk. If no earnings companies are outperforming companies with earnings, 2 points for risk. If no dividend paying companies are really crushing dividend paying companies, 3 points for risk. Guess what? That feels like this current period. So when we look at this model, the curve is basically one standard deviation moments. Basically, when it's well above normal, what we have found empirically is that if you condition a trade at the high end of the speculation, when it's above normal, not the peak, don't get me wrong, we can't just sort of like front run the signal. But if it's well above normal, what are my odds over the next 6-12 months to do well? Bottom line, the expected returns tend to come down sharply. Conversely, when risk appetites have broken to very, very defensive positions, this model tends to suggest that's when you buy risk assets. And so what I'd like to relate is that this model in fall of 20, really the tail end of the rally in the sort of Zoom trade, as I would call it, a tool that we're actually using right now, that broke through in September, October of 2020. Risk appetites had gone too far. In fact, it stretched another 2-3 months well past that reading. And then it broke hard. Risk taking came down like a brick. The subsequent year, what we saw was risk appetites plummeted well below normal, sort of setting the stage for equity assets to come back in favor. It doesn't tell you anything really about which industries, which sectors, but a few things to bear in mind. If risk appetites are breaking hard, what we have learned, not only are returns lower than usual, but what we find is that trending factors and expensive stocks come down especially hard. Undervalued stocks, earnings visibility offers protection, maybe no surprise. And so where we're at least for this simple model, is that risk appetites are steadying. They're starting to reverse course, but we're sort of business as usual. It just in the last month climbed up slightly above normal. So what this tells us is that, hey, if you've got a trending market and risk appetites haven't broken through these sort of extremes, guess what? Even if you're uncomfortable, there's plenty of room here for this trade to continue. Let me flip it to another way, the way the newspapers sort of talk about this. The market ran up today because of short sellers reversing. It's always a line. If you read the journal for the last few decades, they'll use it. I'm not sure where they get the information, but the reality is that there are people that are terribly defensive and they're feeling this performance pain. They've got to explain their statements away. Do they cast in or don't they? I would argue there in the last few weeks, we've had more and more bearish people cast into this market because they can't stomach it anymore. So this is telling us that we've probably got a little bit more of that behavior. The other components, asset allocation. The Cirrus asset allocation model basically in about 6-9 months ago started to go back favorably into equities. One of the indicators, by the way, is what we just talked about, risk appetite. That model basically started to force us back into equities as uncomfortable as we were. And to this date, this number is now, even with the explosive June and May that we had, this model's come back down into like a 50, 55, 60% handle on asset allocation to equities. So in other words, here's another model that's basically telling us that, risk assets are still on the menu. And to the third point that I want to get to is really what has changed the most in the last 5 months, which is our crowding measure. Our crowding measure just went negative. That reading was benign for the last year and just downright bearish, I think, the year before. And again, this was another model that pierced this sort of sell region back in September, October of 2020. It went higher. So what I'm not trying to say is that the moment this thing breaks through, it's over. But from a probability standpoint, the clock is now ticking. If we had a sound studio, we'd probably run the 60-minute track tape at this point. But the bottom line is this is starting to tell us, compared to about the last 2-3 months, that, okay, we finally have one of these tactical measures that are telling us, hey, something is changing. And so polarization in the market is now extreme. Our Cirrus polarization quotient is a little bit different. I think the technicians' sort of angle on this is that, hey, did you know 7% of 7 names in the market generated X% of returns? Yes, that's not a good statistic, but I'm not sure it's useful from a timing standpoint. I prefer this sort of model that we're using because what we're doing is we're looking at strong performing stocks. But what we're trying to say is, what can the multiple trade at? And so this reading basically is a simple PE model off of trending stocks. So once those multiples get stupid, they're normalized against the market. That's when we really have a problem. All right. The fourth element that I want to talk about will cut both ways, and that's the credit markets and interest rates. At the heart of it, I believe what could sustain this rally further is that if the Fed were to turn around and at some point say, oh my gosh, we messed up, we're going into a recession, we need to now add liquidity, we need to now cut rates. And that would be a wonderful bullish scenario for this current trade, where the high-tech stocks with really, really aggressive multiples are allowed to stay exactly where they are. So if the whole economy is slowing, then there's so many other cyclical names that should pull you down. What we are seeing is pretty much the opposite. That what we have seen from the initial Fed move, credit spreads widening, stock market selling off. In the last year, we've seen credit spreads reverse course by over 100 basis points down to currently we're about 550 above Treasury, which I would argue is sort of a normal world, not a bad world for funding for businesses. When it was at the 300 level back in the latter stages of the pandemic, I would say that was just a weird world. That was like very basically zero interest rate type of world. So I do think this is much more normal, and it is not telling us that we're barreling into a recession, which would give us a Fed rate relief. So moral of the story is that in order to see this sort of market continue in its run, the interest rate support should be there. Right now, the Fed is basically running through its course. I don't think it's shocked anyone in the trajectory in the last 6 months. Maybe the initial move was very, very gut wrenching, but I think they've been very steady in what they're saying they're going to do, and the market seems to be accepting it. And then, as always, I think all market watchers are always claiming the Fed's wrong. So clearly they're steering us off the cliff again and again and again. Right now, the jobs data, the yield curve, in fact, the backup in the 10 years telling us that the market is not exactly worried about a recession in the next few months. So this will be very telling. If we don't get an interest rate relief, the clock will be ticking even faster on this momentum, high multiple tech run. So this is the sort of stuff that we are watching. What I want to shift to, though, so tactically, what I've gone through are 3 or 4 elements: risk appetites, asset allocation to risk assets, crowding factors, and the interest rate backdrop. Do we get easy money or not? Shifting course, though, that, what this would tell us is that these elements right now are saying things are still okay. A dark scenario that would really end this sort of trade, which I don't think we have it at our sites, but what if not only is the economy stabilizing, but we end up getting some sort of surge of growth or some sort of reacceleration in pricing issues and inflation, the inflation data, the jobs data end up being stronger than we think. So the fact that the 10 years backed up from a 3.5 handle to 4 in the last few months, does that get a lot worse in the sense that does it climb further? Very counter to this argument of the last few months that we're barreling into a recession. Okay, strategically though, let's put this thing in place. This is the stuff that more of us are going to be comfortable with. Technology multiples. We've published a really neat piece. Nick Pilar on the team published this piece on from the Industry Outliers report, and I thought I think it's a very interesting way to think about technology multiples. Not to say are technology multiples in an absolute sense expensive or relative to the market. It could be spending data in the tech vertical that allows tech stocks to climb a lot higher. What this did, though, was to look at the larger technology stocks against the smaller technology stocks. In theory, they're in the same ecosystem. If spending in the technology vertical is good, these firms should benefit. We don't need to question whether the largest name should benefit more. But what we are seeing is a complete tale of two cities. We're now looking at basically 3 times multiples of the large tech names using an EV to sales measure versus the smaller tech stocks. This is 30 years of data. We've sort of climbed through those highs. I can wager this goes back. We have this data back to the 70s. This is pretty extreme stuff. So on the surface, if there's something really special going on in the technology space and the rest of the economy is tanking, this chart sort of explains it. But here's the problem. The other way of looking at this is to think about these multiples in the face of technology demand. And when we look at, we've got a model that we branded the DDI, or digital deflation model. And what it does is it quietly looks to all these little components in the business cycle for technology goods. So what's the chip data moving at? What's hiring in the technology space moving at? What are credit spreads in technology versus the rest of the system? All of these things. And what this reading is suggesting is that the sort of demand side, the DDI, is plummeting. It started over a year and a half ago, right after the sort of initial rebound with the spending in the pandemic, and it started to roll over. So what we have is a pretty massive gap between where market expectations are and the sort of ground level behavior. I think just yesterday, Microsoft announced another 10,000 folks that are going to be laid off. And if I'm a perma bull, I'd probably say, oh, wow, that's great. Microsoft margins are going to get better. I love high margin companies. But you know what? As a business owner, nobody wants to cut their people. And the only reason you cut people is when you and your team look forward a year or so out and you're like, oh my gosh, business is going to be soft. I think we're connected with these people. My managers are connected with these people, but we're going to have to cut them. And so I think what's embedded in our DDI are simple things like tech labor trends, and it ain't good. So the moral of the story is that this gap that's opening is pretty serious. And, from a benchmark standpoint, if we got to own some more of these, watch the tactical stuff, we'll do that. I mean, I'm not enjoying the moment, But we've done stuff
You
like that.
enjoyed this episode of Market Conversation. And as always, look forward to hearing from you and feedback. Thank you.